Uh, so hello, everyone. Welcome to the second session of Financial Literacy 101, four-part series co-produced by the Canadian Women's Chamber of Commerce and the Women's Entrepreneurship Knowledge Hub. This series is for service providers who work with women entrepreneurs to develop their core financial literacy skills so that they can better support their clients when they are asked questions around business finance and lending particularly. So let me share my screen briefly here. So last session, we had the CRA come and talk to us a bit about registering for different CRA accounts. Today, we are talking about how to answer questions around financing. And just before we start, I'd like to take a moment to acknowledge the Indigenous people of all the lands which we call home. We do this to reaffirm our commitment and responsibility to improve the relationships between nations and to develop our own understanding of local Indigenous people and their cultures. Since we are meeting on a virtual platform, we acknowledge the ancestral and unceded territory of all the Inuit, Métis, and First Nations people from coast to coast to coast. Please join me in a moment of reflection to acknowledge the harms and mistakes of the past and consider how we can each in our own way try to move forward in a spirit of reconciliation and collaboration. So my name is Nancy Wilson, and I'm going to be your host today. I'm the founder and CEO of the Canadian Women's Chamber of Commerce, or CanWCC for short. CanWCC is Canada's only chamber of commerce that represents and advocates for women identified and non-binary entrepreneurs, founders, and business owners. We support women entrepreneurs directly by providing a community, resources, excuse me, and advocacy to eliminate or mitigate systemic barriers to their success. We also partner with service providers like yourselves to promote your work and to refer our members to your organizations in the community. CanWCC is proud to be a partner organization of the Women's Entrepreneurship Knowledge Hub. And I'm going to turn it over to Shannon Peston, who works with the Women's Entrepreneurship Knowledge Hub. And she's going to tell you a little bit more about the hub.
Hi, good morning. Thank you, Nancy, for the introduction. And on behalf of the Women's Entrepreneurship Knowledge Hub, thank you to all of you for joining us today. The Women's Entrepreneurship Knowledge Hub is part of Canada's Women's Entrepreneurship Strategy, and we share research and resources on women entrepreneurs in Canada. We're made up of 10 regional hubs from across the country, and we operate in both official languages. And we have a network of over 250 organizations that reaches together over 100,000 women entrepreneurs. You know, in our research, we know that women face unique barriers in entrepreneurship. And one of the barriers is access to financial information and entrepreneurial capital. And financial literacy plays a really important role for women entrepreneurs, but at the same time, it also plays a very important role with service providers who directly support women entrepreneurs. Today's presentation, which is brought to you by Laura Didick over at BDC and Alex Bertok, will look at some of the concepts around financing, and I'm really looking forward to this presentation. As we look to building a more inclusive ecosystem and an environment that supports women entrepreneurs, these topics are more important than ever. And I thank you all for joining us. Nancy, I will pass it back over to you. Thank you.
Thanks, Shannon. Um, so before I introduce our presenters today, I just want to go over a couple of things. So we are going to have time for Q&A following the presentation. So make sure to enter your questions into the Q&A box, not the chat box. So I have a team member here from CanWCC. Her name is Tasha, and she's going to be monitoring the chat box if you have any kind of technical questions or anything going on during the presentation. But if you have questions for the presenters, make sure to post them in the Q&A box. That's where we'll be looking during the audience Q&A. Also, make sure that the questions that you post are of a general nature. We can't, or certainly the presenters can't really address specific questions about a specific scenario or anything like that. Make sure or try to ask questions that are general enough that the answer to those questions are going to benefit everybody on the call. The BDC is certainly around to take individual questions and answer them one-on-one about specific scenarios, but not today, not during the presentation. Finally, everyone is going to receive a list of resources emailed to them after the presentation and a copy of the slides, I believe. Is that right, Laura? Yeah. Sure. So they'll get a copy of the slides. So so don't waste time or energy making too many notes. You're going to get a copy of the slides. Just listen, absorb the information. That is the best use of your time during the presentation. Okay, that's all of my advice, or I don't know. I'll move on from here. So our presenters today are from the BDC, the Business Development Bank of Canada. Alex Bertok is joining us shortly, and he is a passionate account manager in the BDC's Toronto Entrepreneurship Center. He works with businesses and women entrepreneurs to provide financing and advisory services. He's been at the BDC since 2016, and he's actively involved in their diversity and inclusion strategies. And he is a women's entrepreneur champion on his team and a BDC Innovation Fellow. Laura Didick is Vice President and the National Lead for Women Entrepreneurs at the BDC. She's a sought-after speaker and presenter on the topic of women entrepreneurs and leadership, and I'm so pleased to welcome her today. Laura, I'm going to turn it over to you.
Thank you. Thanks, Nancy, and thanks for having me. I'm just going to share my screen. Good morning or good afternoon, everyone, depending on what side and what part of the country you come from. For me, it's still morning. I hope everyone can see. Nancy, maybe you can just confirm. Can you see my screen?
Yep.
Perfect. Excellent. Okay. So thanks for having us. I'm going to start the presentation, and then I am going to turn it over to Alex, who's going to complete it, and then you can ask him all the tough questions and me all the easy questions. He says that the questions will be held for later. And the reason why we don't ask for, specific individual scenarios is that number one is we don't have all the information, and number two is, and we're more than glad to take those offline with you, but it doesn't really benefit the other participants we find when we get those questions. So I find if you keep the questions very general for the benefit of everyone, then everyone can benefit from them. So today we're going to talk about financing, and I mean, to be successful and remain in business, both profitability and growth are important and necessary for a company to survive and to remain attractive. So profitability is, of course, critical to any company's success. That goes without saying. But growth is crucial for long-term survival. So without sufficient capital or the financial resources used to sustain and run a company, business failure is imminent. Goes without saying. No business can survive a significant amount of time without making a profit and or having enough cash to pay for their expenses, but also to grow. And that's really important. It takes a lot, it takes as much money to grow a company as it takes to start a company often. And now economic cycles happened, and now we realize that a global pandemic can be inevitable. And so businesses have to be ready for them. And that's one thing that I think businesses in general have really learned through this is the need to kind of be fairly prepared, and how many that weren't. And obviously, who could have seen what has happened come, but at least to be prepared for some sort of downturn. And in this case, we saw a huge downturn. And what I find what's really alarming is a recent KPMG study reported that nearly a third of all SMEs, and now this KPMG study was just done in October, so it's fairly recent. So nearly a third of all Canadian small and medium-sized enterprises worry that they don't have enough money or access to credit to survive another significant economic downturn that could be caused by a second wave, which I think that we can all agree that we're probably in. So this topic is really, really important, and really glad that we're covering it today. So many of you may ask, and you probably get asked quite a bit, is what is the difference between debt and equity? And I know that, you know, it seems like a fairly simple question, but debt is basically money borrowed from an external lender. Equity is funds in exchange for ownership. So you're getting money and you're giving them, you know, the company is giving them some of the equity in the company. So debt can come from things like financial institutions, so banks, credit unions, even fintechs, or you're seeing more of those now. And even now you're seeing companies like Shopify and PayPal doing lending for small business. Retailers is also a source of capital, and this is through, you know, purchasing goods for a business through store credit via a finance card. So you'll see that, like a Staples credit card, and a lot of these companies are coming out with these credit cards specifically tied to their business to encourage you to shop there, for companies to shop there. So store credit cards can have they attract very high interest rates. However, some retailers offer, you know, interest-free periods, and it's another way to get financing. Suppliers is another way to get financing. I mean, this is through pushing the company's suppliers to the very extreme, whether it be 30 days or even 60 days, or, you know, to push them as far as you can. And then factor companies. Factor companies is something that's not really well known, but I think it's important that you're aware of it. So when you're dealing with your clients, that it may be an option. I think these are all options for companies. And factoring is when a business sells its accounts receivable or its invoices to a third party, which is called a factor. So it can receive cash right away without waiting to collect from that customer. So customers will then pay their invoice directly to that factor company. Obviously, there's a cost to that, but it allows a company to get the, you know, and this can be very, very prudent in an industry where, you know, receivables are really pushed to, you know, 30, 60, and 90 days, and the company needs the money right away. Family and friends is probably the most well-known form of debt, where, you know, it can be equity or it can be debt, where a family or friend will either lend to a company at an interest rate, or usually a low interest rate, or will actually invest in the company for equity. And then crowdfunding. We're seeing more and more crowdfunding come up, and crowdfunding also can be debt or equity, as well as government. I have on both sides. And crowdfunding is raising money through the collective efforts of a large pool of individuals. So, you know, primarily it's done online or via social media, or there's crowdfunding platforms that is growing. And this is very prevalent in women entrepreneurs. Women tend to be more attracted to crowdfunding, and they tend to have more success, the studies show. It also allows a company to, and crowdfunding can be via equity or it can be via debt. And it also allows a company an opportunity to validate their idea or their product or their service. And so it's a great way to do that. So this is also really, really growing. And the last, as I mentioned, was government. So government can come in, different loan or grant initiatives, and we're seeing more and more of those come up now. Sometimes repayable, sometimes not repayable, sometimes in the form of zero interest rate, and there's different forms of that. So different forms of financing, as I talked about, is your personal financing. So self-funding a business via your personal savings or the sale of personal assets. This is you investing your money, or using family and friends, getting family and friends to invest your money for a share of the company, whether they be silent or not silent. Venture capitalists is professional investors that invest large funds into a business. And just remember that venture capitalists are looking for high growth and high profit, because they're looking to make money on their investment and to get out within a number of years. And then private investors, and I put private investors separately because this is like a venture capitalist, but it's not. They're also known as business angels. And these are generally, wealthy individuals who've made large sums of money. They're sometimes, they were entrepreneurs themselves, and they want to pay it forward. They want to invest in companies in return for some equity and a share of the profits. In between debt and equity, that we'll talk about later, is another interesting product called quasi-equity or mezzanine financing that kind of has the features of both. And we'll talk about this later, just so you're aware of it. Not super common and not for everybody, but it's good to know. So here are some of the pros and the cons of debt financing. So the pros, and I kind of have tried to lump it into three. Obviously, there's probably a lot more, but these are the biggest ones. The biggest and most obvious advantage of debt is control and ownership. And this really, really, really is a big reason why a lot of entrepreneurs use debt instead of equity. Even if they can get equity. So with traditional types of debt financing, you are not giving up controlling interest in your business. And it's all yours. You continue to make all the decisions. You keep all the profits. No one's going to kick you out of your company. No one's going to tell you how to run your company. So probably the biggest pro. Another major benefit that's frequently overlooked is that business debt can also create more tax deductions because the costs are tax deductible. Now, this may not have a big impact on a company at the seed stage, at the startup stage, because the profits aren't there yet, so they're not really looking for the tax deduction, but can make a huge difference as the net profits of a company grows and yields positive revenues and positive profits, and they're looking for ways to decrease their profits. Is when they, a lot of why I put this here is because a lot of companies often talk about the costs of debt, but what they forget is that the costs that are being quoted are less than that because they are tax deductible, and we'll go through that a little bit later. And then finally is flexibility. Sometimes and normally, to an extent, and we'll go through this a little bit later, is debt does offer flexibility. You may be able to get favorable repayment terms. You may be able to get a short deferment of interest only at the start. You may be able to do seasonal payments, graduated payments, things like that. So the most significant danger and disadvantage of debt is that obviously it requires repayment. It's rented money. No matter how well you're doing or how well you're not doing, and you might be burning through cash for the first couple of years. A company may be burning through cash with little way of making a net profit, yet that those monthly payments are still there every single month. The bank, and I'm being extreme, but the bank doesn't really care how well you're doing. The repayment terms are still there. And this can be a huge burden, especially on a startup when they're burning through a lot of cash in the beginning and don't necessarily have that profitability or that cash flow. Your loan payments do kick in shortly after the loan is disbursed. So sometimes you can get an interest-only period for a few months. But obviously, having the loan payments kick in almost immediately after the loan is disbursed, before a company gets the benefit of doing whatever they wanted to do with that money, it can be a cash drain on the business. And obviously, there's the risk of variable interest rates. If the company's on a variable interest rate and interest rates change dramatically, it seems to be can be a risk, not right now, but it can be a risk, then the repayment terms change, because usually they're blended. And even if they're not blended, if interest rates go up, then the costs to the company go up. And also what's important is there's no guarantee of future availability of capital in debt. So in other words, if a company buys a building and it's amortized over 20 years, the term may only be 5 years. And so in 5 years' time, that company has to come back and renegotiate. And it's not a sure thing, even if they've been paying their debt as agreed, it's not a sure thing that the bank has to continue. You need to renegotiate. So that's obviously just a risk to a company. And then lastly, and this is probably the most prevalent, is if entrepreneurs have not separated, and this happens a lot, especially if a company has not incorporated, if entrepreneurs have not separated their personal and their business credit, they may find that their entire life's work and accomplishments are on the line if they default on their debt. So this is really important, because some entrepreneurs don't really realize this, especially if they're operating as a proprietorship. So, a business owner's home, their cars, their washing machine, their kids' college funds can all become collateral damage if the loan is not repaid, and if there's not a wall built between the debt and their personal lending. So also with equity financing, the pros and the cons, I've kind of tried to lump it into 3 just to make it fairly easy. But the pros is that equity is patient. The funds don't need to be paid back immediately. So the company gets an injection of capital that they can use to grow their business, and then the funds don't have to be repaid immediately. And because of that, it supports the cash flow, because the profits are not being used for debt repayment. And also what some companies don't really realize is that, getting investors can add additional credibility, depending on who it is, obviously, and skill sets that a business sometimes needs, and some highly visible individuals that can sometimes help their business, and a certain expertise that they want. Obviously, they can always hire that out. But if it's an investor, they have a vested interest. On the con side, obviously the biggest one is the owner is giving up ownership, and we've gone through that. And possibly, even if they say they're going to be silent, possibly have the ability, even if they're just a minority, can have a say in the business and can become a thorn in a business owner's side, we'll say. And it also can take a lot of time to get the right investor. It can take a lot of time, and it can take a lot of money. And don't forget that when an investor invests in a business, in almost all cases, the reason is to make money. That's why they're investing. That's why they're putting their money into the stock market. That's why they're putting into a company. That's why they're putting it into your company. So, that's what their ultimate, in most cases, that's what they ultimately want. So it can be costly, and it can be costly to get your financial statements in order and to get all the, everything that they want in order. And so that's something to remember. And it's definitely more costly than debt in the end. So what types of debt or of financing are available? So these are the different types of financing. There are generally 2 types of financing. There's revolving and there's term debt. Revolving facilities are extend a company's cash resources. So they're like an overdraft, a line of credit, a Visa business card is a form of it. In a line of credit, which is the most common, the small business owner is granted a pre-approved amount, so a credit limit that the borrower, may choose to use, or may choose to use just a portion of it, or may not need it at all. It's kind of like the sleep money, that if that customer doesn't quite pay on time, then they have the line of credit available to still pay their employees and to buy more inventory and things like that. So it's the reason for it is really for timing differences, and can become quite useful. The borrowers charged interest rates only on the amount borrowed, so not on the total amount that's approved. So whatever portion they don't use, and the intention of it in a line of credit, in most cases, it's supposed to revolve, like it's supposed to go up and down almost on a daily basis. It's like a business credit card, but with a much higher limit in most cases. And you know, and can be used for things that may not be accessible using a credit card. So it's usually the cheapest forms of financing. And what, you know, we suggest is that every business, if they can get a line of credit, they should, because if they don't use it, it doesn't usually cost them anything or much, and it's there if they need it. It's the sleep money, and it's the money that can get them through if they need it. A line of credit can be secured, or it can be unsecured. A secured business line of credit requires a business to pledge specific assets and as collateral to secure the line. So a line of credit is considered like a short-term liability. It goes up and down. So lenders typically ask for short-term assets. So usually it's margined on a company's accounts receivable and their inventory. And what the bank will do is they will discount the security items. So for instance, they may say, you know, the business can have up to $25,000 maximum line of credit based on 75% of their receivables and 50% of their inventory. And so the actual amount, the maximum amount can fluctuate a little bit because that's the security they're taking. And normally it is receivables and inventory. If the borrower is unable to pay the line of credit back, then the lender, you know, will, that's their security, that's their collateral. In an unsecured business line of credit, you know, the bank does not require specific assets as collateral. However, you know, we'll take a general lien over the business, and possibly a personal guarantee will be required, but there's no specific, it's not tied to like the specific receivables, for instance, or inventory on this type of credit. And usually if they're going to do this, you know, the business will likely need to have a stronger credit profile along with an already positive track record to qualify, because this is very risky, considered to be very risky for the bank. And often because of that, an unsecured credit facility, you know, may be smaller than what it would be in a secured. On the other side, we have what we call term debt. And term debt is intended to be fully dispersed in kind of one or two kind of payments for a specific purchase or project, and then repaid in regular installments, usually monthly, over a set period of time. So term loans are most often used to finance fixed assets such as equipment, buildings. Depending on the reasons for the loan can be considered what's called short-term in nature, which would mean maybe, you know, 3 to 8 years, or longer term in nature, which is, you know, 20 to 25 years if they're buying a building. And the amortization period is, I'll just touch on this a little bit because it's not well understood, is that the bank will negotiate and will give an amortization period and a term. And an amortization period is the total length of time that it takes to repay the debt. So we'll use a building, for instance. A company is buying or building their building out of a leased facility, out of a leased premise, and they borrow, and the amortization period, let's say, is 25 years, which means the bank will take, you know, if it's $1 million, the bank will have that repaid over 25 years, usually in monthly equal installments plus interest, but of 25 years. The term that they negotiate is usually, say it's a 5-year term. So, you know, you can pick a 5-year the company can pick a 5-year interest rate or a variable interest rate. And that means that's what the term of that loan in 5 years, then the entrepreneur comes back and renegotiates the interest rate. The bank will relook at it, the security and everything. So that's what I mean by one of the risks is that, you know, the banks are managing their own risk. So if they find that in their portfolio, they may have a certain industry that they have too much lending in one industry, and their risk is getting too high, they may decide to exit or not exit, but decrease their exposure in a certain industry. So it may become more difficult after the term for you to renegotiate, or they may get a little more stringent, or, you know, the costs may go up or something, because they are looking at their whole risk. So just like you're looking at the company's looking at their risk, they're looking at their own risk. That makes sense. Whoops. Oops. Uh-oh. Okay, sorry. There we go. So I talked about, I mentioned there's another that lands in between debt and equity, and this is called mezzanine financing. I'm not going to spend a lot of time on this because it's not super well, it's not used a lot, but it's worth mentioning because it is another form of debt. Mezzanine financing can also be called junior debt, subordinate financing. I've heard it called quasi-equity financing, and it's basically a hybrid of debt and equity. So it shares some of the characteristics of debt financing. Because the borrower has the obligation to repay, it's still rented money, it needs to be repaid. But on the other hand, it mimics equity financing because repayment is based on cash flow rather than the depreciating assets. So in this kind of debt, what happens is the lender often or will subordinate their security, they'll subordinate their position behind all the other lenders. So they come in behind the senior banks in whatever they're lending in, but they come ahead of the shareholders. So they're kind of, I don't want to say at the back of the bus because the shareholders are at the very back of the bus, but they're kind of in the second last seat. So because of that, I mean, the return, the expected return is higher. But what's really interesting about this is that it has the repayment is customized based on the cash inflows and outflows of the company, and it's non-dilutive. So the lender does not take an equity position. And usually, in most cases, the return to the lender is a coupon, so an interest rate, plus what we'll call a sweetener, or what I call a kicker. So the sweetener is based on the success of the company. So it may be a royalty on sales, it may be a percentage of EBITDA, it may be through an option or a warrant or something like that. So the idea is that that's where it kind of mirrors equity, and the repayment, there may be maybe a 5-year with no repayment, interest only on the coupon, with a balloon payment at the end of 5 years. So it's kind of gotten some of the features of debt and some of the features of equity. And it's really interesting. And it kind of started in our knowledge-based industry, where the assets go home at 5 o'clock and there is no collateral for a lender. And this is where this really started. But it's becoming more and more common in a company that is looking for financing to grow, or even in a management buyout situation or something, and they don't have the assets, or the assets are already pledged to a lender, and their only other option is equity, but they don't want to dilute. So mezzanine financing is an option for them. And this is the different kinds of debt and the equity. This is where it sits. So you can see on the vertical, we have risk, and on the horizontal, we have return. And this is, risk, not from the entrepreneur's standpoint, but from the lender's standpoint, I guess we'll say. And what happens is that obviously as the risk goes up, the expected return, the return that the investor or the lender will want. So you can see on the far left-hand side, you have traditional debt, just a traditional loan, whether it be a mortgage or equipment financing or a line of credit. And so it's the cheapest form of financing because the risk to the lender is the least. They have collateral. They have something to stick a for sale sign on if, in the worst case scenario, the company cannot repay the loan. As the risk goes up, then the return goes up. So in the middle, you have mezzanine financing. You have like a synthetic equity, or I mentioned quasi-equity form of financing. And that is a little bit of the expectation is a little bit of a higher return because the risk goes up. They have some collateral, but it's subordinated to the senior lender. And they have, and they don't have, a first on any collateral. So but they're ahead of the shareholders. And then at the very far right, then you have capital stock or equity. And this is, traditional equity, where a company gets a venture capitalist in or gets some shareholders in. And the expected return, obviously the return does not happen until the investor exits the company. So they sell their position in the company, either back to the shareholder, the starter shareholder, or to the market in a venture capital case that may go public or something. But the expected return, their hope of getting a return, may be north of 25 or 30% at the end. That's what they'll be looking for. And this is just in a different form. I won't go through this in too much detail, but this in a different form kind of shows you the differences between senior debt, mezzanine financing, and equity, just on, the monthly payments or the payments and the security, meaning collateral and things like that. And obviously the involvement of management in a senior debt facility, there's no involvement in management. Mezzanine, they get, they want a little more. They may be silent onlooker onto the board of directors, the advisory committee. And then in equity, they may be very, now I'm not saying that equity, they can't be silent. Some of the equity investors, they may be silent, but they have the right to be part of the board and to have a say in the company. Even if it's not majority, they can voice their opinion. And the other big thing is the return. In senior debt, it's usually fixed. And then as you go up, it turns to variable. So the equity is the return. The investor doesn't know what they'll end up gaining until they exit the company and sell their equity position. So how do you decide between debt and equity? This is a big question that we get. And the choice between the two has both emotional and financial considerations associated with them. And this is very important because nobody can tell a company what is right for them. It's all a personal choice and it's all dependent on every company. So obviously the emotional considerations is in debt financing, you get to own 100% of your business. You get to maintain autonomy. And that's ideally what every business owner wants. That's ultimately the reason why a lot of business owners start. Equity financing can be seen as giving up part of the business, and this may result in loss of autonomy, and thus may negatively affect, the company, the company's owner and the view upon themselves. However, equity can move a company in a positive direction, and it can be a positive decision for any company. For example, if there's a crucial business function that isn't going very well, due to lack of expertise, if you get an angel investor in who's willing to inject their expertise as well as their money, it can help the business. And if the investment and the expertise gets the help that a company needs and gets them to a place where they wouldn't have been able to get with just debt, then sometimes it's worth having what I call a smaller piece of the bigger pie. And nobody can tell a company whether that's right for them. That emotional consideration, that's up to them. And then setting emotions aside, you also have the financial considerations. And this is taking more of a numbered approach. And every company has, different profit margins and bottom line, what their costs are. And so, for debt financing, a company needs to start by determining their cost of capital. And they need to look at the cost of equity. And then for instance, if a company borrows a $100,000 loan, just use easy numbers. And if the interest rate, and we haven't seen these interest rates since I started with the bank 26 years ago, but say 25% interest, just to make it easy, then the cost of capital, the cost of that debt on an interest is $25,000. However, if the corporate tax is say 30%, then the actual cost of capital goes down. So the 25% interest rate is actually only 17.5%, right? Because assuming the company is in a profitable position. So there's financial considerations to take on both debt and equity. And I would suggest that nobody tells a company what they should do. It's completely up to them. There's no silver bullets in the financing world. It's impossible for someone to conclusively say what's best for that company. I think any company owner has to carefully weigh the pros and the cons, and all you can do is point it out for them and select an option that really lines up to their business goals and what they want for themselves. Do they want a smaller piece of that bigger pie? If that bigger pie option is they can see it, or is it really important that they continue to own 100% of the company? On any loan, the lender wants to make a return that's large enough for them to compensate for their risks. I think what people forget is, banks are a business too. And that's how they make their money on the fees and on the interest rate and all the repayments, and they're trying to manage their risk. And the risk to a lender is what you call default risk. It's the risk of having a borrower not being able to repay their loan. And with all else being equal, a long-term loan, so a long-term term loan it's riskier for a lender than a short-term loan or a revolving line of credit for a lender. And you may ask why. Well, simply put, because as time goes by, bad things can happen. We've seen that recently. So if a lender is lending out for 25 years, I mean, they're possibly married to that company for say 25 years on a building. And not only is there risk to the company, because the lender has to assume the company, or has to hope the company's going to stay in business for 25 years, but also in that collateral that they've lent on, call it a building. What is the price of real estate going to do in 25 years in a worst case scenario? And what if the economy falters? What if the business owner runs into bad luck? Things like that. So the money for the lender is tied up for longer, so hence it's riskier for them. They consider it to be riskier for them. So how do lenders decide whether to grant someone a loan? And we're going to go through, and I'm going to turn it over to Alex now, who's going to go through the 5 C's and what a bank, so we thought this would be very beneficial for you as you're talking to your clients or your business owners. What are banks looking for? And we're all kind of looking at it the same way. So we thought, obviously, with a little nuances, but we're all looking at it the same way. So I'm going to turn it over to Alex, who does this for a living, and he's going to go through it.
Hi, everyone. Thank you, Laura, for the introduction. I know personally, this is not the most exciting topic in the world, but it's truly fundamental, whether you're an entrepreneur or working with entrepreneurs day to day. So like Laura mentioned, I'm here to talk about the 5 C's of credit. And then after that, some common mistakes as well that we can learn from, hopefully. So to start off, what does the 5 C's of credit refer to? So it is character, capacity, capital, conditions, and collateral. And they describe the major factors used to determine a borrower's potential creditworthiness when it comes to their business potential financing loan. So in a nutshell, entrepreneurs who want to get the loan will need to satisfy these 5 C's of credit when lending. And I'll say myself, even though we don't check these off every meeting we have, we definitely absolutely put all of these into motion when we're trying to make a sound credit decision, whether we can approve it or not. So getting into it, the first C is character. So most people will describe and affix this to the business owner and the management team, which it is that as well. But also not to forget too, that we also as lenders will look at the previous repayment history and look at their credit history and look at how that's important in terms of the overall character of the entrepreneur to see whether we can lend or not. And just because you're denied at one financial institution, I'll say, doesn't mean another financial institution won't accept your loan. So that's something also to keep in mind. But also as a tip, I would say myself in the field, don't as well too apply to too many places at one time at risk of hurting your personal credit score. So personal character is very important. And it's one that most entrepreneurs are pretty well acumened about. But the most important one as well, I would find, is capacity. And this one is where I find a lot of entrepreneurs don't really understand the capacity of their, really what it means. And that's really what is to the ability to repay their loan. And the most important question to answer on this is, do you have the capacity to repay the loan? This is looking at your financial statements, your financial projections. So looking at what the current operations and benefits of that project are. And as a banker, we're going to want to know how you're going to use the money. What's the viability of that project? Are you using it to help hire someone that's going to help you explore new markets? It's going to help you get a return on investment. Or are you just simply looking for cash flow because you're not too well versed in, cash flow management? Trust me, your banker is going to want to make sure that there's a project there. And we want to see that you're excited about that project. We want to see, I'm using a piece of equipment. I need to purchase a building so I can expand. The point is, we want to have a good idea of the project from the onset. And as an entrepreneur too, you're going to want to know how to evaluate what your use of funds is going to be. And then capacity will come into play there because you want to make sure that you have the bottom line in order to pay for the business loan. And trust me, your banker is going to want to make sure that we're going to be able to have repayment on the loan as well. So another tip I would say too is that when your company is growing and you're seeing lots of more sales, make sure that you're taking a look at your bottom line and bottom end as well, your net profit, because sometimes we'll see companies that are doing very well and growing, but it makes it hard for us as bankers to be able to finance these transactions because the capacity isn't there, because there's not profitability safe in the company or that cash flow for them to be able to repay a business loan. So this is super important to make sure when you're also considering what your cash flow is looking like. The next C, capital. So capital refers to when you're analyzing your present and past financial performance, we're going to look at what your liquidity, growth, and profitability, as well as your cash flow is looking like. You should be able to answer what your participation as a shareholder is in the project. This is also important for startup companies, especially because we're going to want to see lots of participation from the shareholders sharing the risk with a financial institution that you're seeking a loan from. And how much equity do you have in the business? What is the ownership structure? Are they able to sign a guarantee that may or may not be collateralized? These are things to consider when you're looking at the loan, which then segues into collateral, which not so fun, but very important as well too when we're looking at the request, is that we want to know what assets you are willing to provide as collateral to secure the loan. So what do you have as collateral for the financing? It can be a personal guarantee to also being collateralized against assets from the business, as well as assets from yourself personally. So it's important to know what assets, such as equipment, as well as a building in the business, you can do to receive financing, especially when you have good cash flow. But you don't need to have assets in order to receive a business loan. And that's important to know as well. If you have a good cash flow, we'll be able to look at most transactions available. And the fifth one here is conditions. You're going to want to look at when you're looking at your loan requests, the fourth one, when you're looking at your loan request, the bank will review what assets you're willing to provide as a collateral. And so this is important to know when you expect in the details of going over the loan. So people are going to be often focused on the interest rate. This is usually the number one that most entrepreneurs look at. But that's only one element of that equation. And you risk losing flexibility if you put too much emphasis on the interest rate. Look at the benefits of the project you want to refinance or the interest rates to get to a better perspective. Also, don't forget that interest rates are also tax deductible too. As well, you're going to want to look at what's the length of the loan. So you're going to have to look at what's your ability to pay back the loan over what stretch of time. Especially when it comes to equipment, we're going to look at the useful life of the asset that we're going to be financing, as well as when it comes to building or other securitized transactions. But when you're looking at, say, working capital, what is the time, say 5 years, that we're going to be able to look at? Is the business going to be able to have that monthly cash flow to pay back that monthly business payment for the company? So something to consider as well. Collateral. So collateral is also another important point here, because what is the collateral that the lender is wanting? Do you want a full or personal guarantee? So this is important because you want to make sure what you're signing yourself up for as an entrepreneur, and the lender as well too is going to want to know, what are we going to be able to take as collateral in the event that, say, the business may not be able to succeed, or as well just to make sure that we are having good risk judgment as a lender. So those are the 5 essential C's of credit. It's a bit of a mouthful, so we're going to move on to some mistakes now that kind of encapsulate some of those 5 C's as well. So if we want to move forward the slide, I think to mistake number 1. So the first mistake here, when we've looked at, especially when thinking about women entrepreneurs, when we did this study, was that we found that entrepreneurs are borrowing too late. And this means you may be tempted to finance your expansion projects from your cash flow. And our research shows that women entrepreneurs are much more reluctant than men to borrow money and more likely to finance their project growth from working capital. But paying from investments with your own money can put undue financial pressure on your growing business. You may find yourself needing to borrow money quickly and doing it from a position of weakness. When you find there's a sense of urgency, it usually indicates to a banker that there was poor planning. And a better way to go about it is to visit your banker and discuss your plans and financing needs. And this way you can line up the funding before you need it. And if you have a good relationship with your banker, be vocal and honest about what your cash flow is looking like. I know myself, for example, I have a woman entrepreneur, and unfortunately she's not a client yet, but she will always tell me, because we're pretty close, and she'll always tell me, Alex, I really want to get financing, but unfortunately I borrowed too late. So unfortunately, now my business is in a worse position than it was a couple of years ago when I could have taken on a cash flow loan. But now, because I used my own personal funds to invest in that project, now overall to the bank, I'm not seen as a check mark for approval, which is really unfortunate, because if you borrow at the right time, that means you can really make sure that your company is set up for the best success, which kind of goes into the next point here, which is borrowing too little. So as the age-old saying is, too little, too late, right? But you don't want to borrow too little. And the reason why is because you want to be careful of the debt you're taking on, but however, lowballing how much you might need in a project can have your business facing a serious cash crunch when unexpenses crop up. Thinking about, say, buying a piece of equipment, you may be tempted to borrow just enough to pay for it. But what about the other costs? There may be setup expenses, maintenance, and a hit to your cash flow as well when production drops, when you're trying to bring that equipment into full service. And again, as we know, women entrepreneurs tend to be a little bit more conservative than men when coming to borrowing. And our advice is to develop a cash flow forecast for each individual project, including optimistic and pessimistic scenarios. And then that way you can borrow enough money to ensure that it covers your project, can cover the unforeseen contingencies, and the working capital will be able to be sufficient for your project to get to completion. Because I know all too much how many times I've had entrepreneurs, whether they, purchased a building and needed to do some renovations, and those, let's just say, cost overruns, especially if you're in Toronto, the GTA area, I think they go over, 100% of the time. So you're always going to want to make sure that you're developing it, you're adding into your borrowing plan, that there's going to be some additional expenses that you may not account for, because it might be easier to say, I don't need this loan in the future. Let's say cancel, great, Alex, we didn't need the extra 20 grand. But there's times where it's like, I've seen more often not people saying, phew, thank you, Alex, for adding that 20 grand for our new store, because I didn't know how much moving costs were going to add up. I was lowballed when I was talking to my guy about moving, when I was talking to my designer about upgrades. And then all these little small things together, they're like, wow, thank you that I added a bit of contingency to that financing, because now I'm not having to pay out of pocket, or the business now is going to have to kind of recuperate in that cash flow to help pay for those expenses, when that could be paid on really helping the business develop and grow. So too little, too late, try to avoid it is what I'm trying to say. And next point that I'll go on to, and kind of touched on before, was that entrepreneurs, like myself too, when I'm price matching on my Flip app, we focus too much on price and we focus too much on rates. And it's important, but it's far from the whole story. And other factors can be just as important or even more so. So what loan term is the lender willing to offer? What is the percentage of costs that your assets that your lender is willing to finance? What's the flexibility on repayments? Importantly, what are my personal guarantees, and are they being collateralized in any sorts in case that the loan goes into default? Our advice would be to shop around among a couple different financial institutions for the most attractive package, keeping in mind that the important terms are other than the interest rate and the overall picture. And I'll say that because there have been times where I've seen clients sign off their homes, sign off their personal assets, just so that they can get a loan at a lower interest rate. And then they don't realize that, say, if there were, unfortunately, a stick in the road, or, a global pandemic or something like that, unfortunately, that, maybe it was better that way I went with financing with a little bit of a higher interest rate, but they're not going to be taking or looking at my personal assets, and I'm going to be able to protect myself personally. So that way I can focus on my business growing, not worrying about what it's going to do to my own personal assets. what it's going to do to the business and the livelihood of everyone on board. So making sure that you're not focusing too much on that, I would say, is important for success. And going into the next point of paying back your loan too fast, our research would indicate and has shown that women are more likely to pay back their loans early in an effort to become debt-free. And again, I agree myself, it's important to reduce debt, but you have to be careful not to hurt your company's growth prospects. And reducing your debt too quickly could leave you short for cash, or the extra money that you're devoting to paying that debt reduction, you could have been spending on profitable growth projects. There have been instances where people will want to maybe repay their loan. You know, they had a great project, they want to repay their loan because, well, I got the money in the bank. I don't want to have debt. I'm afraid of debt. But then you see, oh no, well now I repaid that debt and now I need double that amount to get this new expansion project. And now I'm in a pinch to go to my lender and try and ask for that money back now, plus more. So it's definitely important that you make sure you're really thinking it through in terms of your cash flow planning. And that's why we recommend that you look at comparing your projected return on investment to how much you're really paying down on your loan faster than required. And if you expect to invest more money in your business, consider slowing down your repayment to free up money to fund your growth. And going into the great next point here, failing to keep your financial house in order. It is so common for entrepreneurs that are super busy working on their actual business day to day to let record keeping and other financial chores slide, especially if you do not have a bookkeeper in house or, you know, an accounting system in place that's very easy and automated to, you know, really do what works in, say, your POS systems, et cetera. And I will tell you that I see a lot of entrepreneurs that I will say, how many sales did you do this month? And they don't know the answer. And that makes it hard then for your banker then to understand, where are you currently at and what cash flow do you need for us to help finance your growth? Because when you're putting those financial chores, I say, aside, then you're not really letting your banker, those people, those really important people, those folks, your accountant, et cetera, to have that information to really help you and give you the right advice and help you grow. So it can make it difficult for us in general for us to approach the loan because we don't have the documentation, but as well, we can't have a sophisticated conversation with the owner about what is your financial concerns? Where were your net income last year? Are we looking to grow that this year? These are different things to consider. So our piece of advice is to be diligent about keeping financial records and to spend the money to hire an accountant. It takes money to make money. And I say it is always important to have a financial advisor, an accountant or bookkeeper in your back pocket to help you really make sure that your finances are in place. Because if the business in total goes wrong, everyone's going to be looking totally down to the finances. And that's where you don't want to, lose track of that when you're focused on the business day to day and not really making sure that you're being attentive to your financial records. And if it's a sore spot for you, we recommend maybe hiring a consultant or advisor who specializes in that to help get you back on track. And as well, maybe help you with your acumen as well, so that you can have sophisticated conversations with influencers and with your banker and investors. Which brings into the great next point here, segues into making a weak pitch to your banker. And we all know from experience and research that many women business owners and business owners in general lack confidence. They can make presenting a loan proposal to a banker a nerve-wracking experience. And as someone that has nerves myself, I totally understand, but fear not, we don't bite, we're not monsters. Feel free to come to approach us and be confident with your plan, because we are excited to hear your plan and we can hear that passion as bankers. And what I'll say is, if you won't be able to go far to persuade your banker to get on board your project if you're not able to understand your pitch as well. So if you're unable to explain your business plan, past performance, competitive advantage, what is your proposed project that we're supposed to be excited about lending to your project bankers, investors, it's going to be difficult. So the solution here is to prepare your pitch and practice it repeatedly, focusing on explaining your business and how you're going to use the money and what you want to borrow in clear, simple, compelling terms. I'm telling you this, it doesn't have to be the perfect Dragon's Den pitch, ready for Michelle Romano. All I'm saying is that you just have to understand, be confident in what you are presenting to your banker. And as well too, I'll say one caveat, one thing side advice is that if you had a bad pitch to your banker at one bank, it doesn't mean now that you're kind of shaken and you won't have that. You'll have that same perception from your banker everywhere you go. Work on your pitch. If it didn't go well the first time, listen to the things that that banker might have said, that I'm not understanding your cash flow, or I'm not understanding this. This isn't clear. Take mental notes. If for sake you do have, for some reason, not the best pitch that day to your banker, and then when you're ready to, go back to them or go to a different bank, you're going to have, some great points to go off of to be able to really work better and then know exactly what they're looking for. And remember that a big part of your job is for helping sales and persuading your clients. And so that's going to be the same thing as persuading your banker. And that's going to start in, having a smart, strong management team. So be proud of yourself and don't be afraid to ask from help from your friends, family, your associates to try getting your pitch right, because they're all pulling for you. And finally, number 7, depending on just one lender. Having a relationship with just one institution can limit your options, especially if your business hits a bump in the road. You don't want one lender holding all the cards if something does go wrong. And I always say, don't have all your eggs in one basket, because as you would want to diversify your suppliers or customer base, you definitely would want to diversify your personal, your investments. And that comes to your lending relationships, as well as your, investors as well too. It comes to everything, just making sure that you're keeping conversations and your eye on the pulse on different products at different institutions, because you could be losing on important advantages and say cash flow products, perhaps, if you're not in touch with different lenders, or at least knowing what the scope is available for you out there. Because too often than not, people will get their 200-gram business grown for 3 new hires. Great. And then we don't hear from you again for 5 years until the loan's repaid. And that is not okay. You need to be making sure that you are talking to different bankers, talking to your current banker, making sure, hey, Alex, what's the best loan right now? Am I having a loan that's, suitable for what my business is currently at? I got this loan 4 years ago. Where do you see, Alex, our relationship and our lending, criteria being at this point? So all I say is keep having conversations with your banker, keep having conversations with other bankers, and having those actual financial lending relationships with those other bankers, because it's always better to have 2 doors to knock on if you need financing, 3 doors, 4, 5, than to only have 1 door to knock on, because that leaves not a lot of more vulnerability for yourself as an entrepreneur when you don't have those options to work with. And who doesn't love options? So don't work with just one lender. Keep your conversations abroad, and work with different agencies, because it will really help your company grow further and minimize your risk. And I think that comes to the end of some simple mistakes. I'll pass it back to you, Nancy, and we can get into some Q&A.
Muted. Thank you so much, Laura and Alex. So we're going to move to the Q&A section of the presentation. We have a couple of questions and comments here already. The first comment actually comes from Michelle. I'm just going to throw it out there because I think it has to be said. It says, not a question, but a comment. Laura is an incredible speaker and presenter. I've heard her speak at quite a few of these WEKH seminars so far, and I am consistently impressed. I agree. Fantastic.
Thank you. That's very nice of you, especially for a Monday morning.
Yeah. Okay. Question from Nicole. Just wondering, this is a really important question, actually. So I think Laura should answer this one. Just wondering whether anti-racism work is being undertaken in financial institutions to counter implicit bias that could come up when bankers use character and capacity to evaluate lending decisions, as those sound quite subjective?
Yeah, so I mean, great question. I can't speak to other institutions. I can only speak to our own, but I can say about all institutions, including ourselves, is that, I mean, obviously diversity and inclusion is very important, not only internally to all of our organizations, but also externally. I mean, I think it not only is having diversity amongst our clients and amongst our employee bases. And I say we as in the collective we, being all the financial institutions and all business in general, isn't only the right thing to do, but it makes good business sense. I mean, there's been numerous studies that have shown that it leads to higher revenues, higher profits, better innovation. I mean, I can go on and on and on. I don't think I need to tell this group that. So the direct answer to your question is, from our standpoint, yes, we've actually rolled out last year, we just finished it just before the pandemic hit, was we we called it Getting Gender Smart, is we did internal training for all of our client-facing employees on gender diversity. And so what the differences are generally between women entrepreneurs and male entrepreneurs, in that, for instance, women entrepreneurs are not risk adverse, they're more risk aware. So they just look at risk differently, they communicate differently, they have different levels of reasons why they start a business, they have different levels of financial literacy. I'm generalizing, obviously you can't say that about all women entrepreneurs, but so we rolled that out. We're now working on for other segments of the community. So we're looking at Black entrepreneurs, looking at LGBTQ+, and we are rolling out training. We're working on it right now for the spring on, again, training all our employees, not only for working externally with clients, but also internally, obviously, and looking at ourselves. And I can only assume that other institutions are doing the same, because I know it's as important to them.
Yeah. And I know, Alex, you're involved in diversity and inclusivity work that the BDC does as well, correct?
Correct, absolutely. And BDCs, I can again speak for BDC. We definitely are very focused on diversity and inclusion, and helping as well too, making sure people like myself on the front line are a part of that change and evolution as well. So I myself have been able to present to our floor and team on LGBT business development, looking at unconscious biases, in say the LGBTQ2+ community. So it's very important, and we recognize in our work, and I recognize the importance in what I do day to day. And thank you for the question, in that we're working to remove those biases, because it's no secret that the question was, it's a good question, because financial institutions in the past have definitely, and the world of entrepreneurship has definitely been more straight white male focused. There's no lying about that. So it's really about all of us and our stewardship to be, getting us all onto the next page, whether it's, from, a large corporate, initiative, to it really trickles down to people like myself in the bottom every day, and what I do to make sure that entrepreneurs that have been perhaps systematically not been, received well at other financial institutions or in the past, that we're doing the work to make sure that they feel welcome, and that they know it's not a bias in terms of their application and their lending criteria for us. So very important.
Great.
I think, Nancy, just on that, just while Alex was talking, just one more thing and then we'll move on, is that it's also important. Access to financing and capital is important. It's also access to markets. And so that was one of the reasons why just 2 years ago, we started to undergo, and we now have implemented in the last 18 months, a supplier diversity program, because we need our clients to be completely diverse. We need our employees to be completely diverse, but we have to make sure that our suppliers also are diverse. And so, and I know that I think all the banks have done that or are doing that too. And supplier diversity is very important.
Yeah, great. So Erin asks, what are your thoughts on interest-free loans? She knows a charity that offers this.
Well, I mean, like, I bought a car a little while ago, and it was an interest-free loan. He said it's 0% interest, and I'm a banker. And I said, oh, okay, well then I'm going to go for it. And I said, but what's the penalties if I pay back early? Can I pay back early? And he looked at me, he said, you said you're a banker, right? And I said, yeah. And he said, why would you want to pay back early at 0% interest? And I went, okay, good point. So, I mean, I'd say, yeah, I mean, 0% interest is unbelievable. I would have to ask, just before you do anything, no matter what debt or equity, before you sign anything, you recommend that any of your clients obviously get legal and financial advice, being from their accounting advice, to make sure they know what they're signing. I mean, I don't have any specific opinion because I'm not familiar with the charity or the reasons or what their mandate is. But, just make sure if anything is in, and it will be in writing, that you get the proper advice that you need. Alex, can you add anything?
I just echo the same thing as you. And I would say just always read the paperwork, as I'll say, because that sounds almost too good to be true. But if it's from a charity, I know there are these ones that exist, but it sounds so it's great. But I would just make sure, read the paperwork before you sign on the dotted line.
Yeah. I would agree with that. Yeah. It makes me think of the offers for like credit cards where you can like transfer a balance for like 0% interest. But if you don't read the fine print, then anyways, there's often catches. But I mean, very often legitimate offers of 0% interest. Just monitor those payback deadlines, because anyways, fine print is always a good idea regardless of the offer. Okay, I'm gonna jump to Joan's question. Okay, I have a question about the deductibility of interest payments. My previous understanding was that only interest payments used to purchase investments are deductible. However, Alex, you stated that other interest payments are also deductible.
So I don't know the specifics around that for sure. So maybe we can take it offline and I can take a look into it. I don't know that exactly, but I know that the government does have some exemptions for tax and interest payments. So maybe something to look in further, something that's not my area of specialization per se, but always happy to look into it and ask my partners if they might know.
Yeah, and if you have an incorporated company, I mean, your interest payments on your debt are part of your income statement, which then minimize or decreases your. I mean, obviously, it depends on every business is different. So obviously, your accountant is the one that knows, but they, interest payments typically in an incorporated company are tax deductible.
Yeah, I would think so. Kate asks, can you recommend this is a great question. Can you recommend good first steps to building business credit history?
Yeah, so this is so important, and so many, and especially, and again, I'm generalizing, but so many women entrepreneurs tend to use their credit cards and personal savings to start a business. And I always say, get your credit history started early. And the best time, and Alex mentioned it in his presentation, the best time it was in borrowing too late. The best time to borrow money is when you don't need it, really. When things are really good. It's not when, your employees needed to be paid 2 weeks ago and you ran out of money, and, or you're using one credit card to pay another credit card. And, so I recommend very early on when you're starting a business is to look for even a little bit of debt, just to start that debt. And so, there's lots of Startup Canada, Futurepreneur, depending on your age. I mean, ourselves, your bank, I always recommend to any entrepreneur, the first place to start is where their personal stuff is, because that bank, you use that character, usually most people have had a car loan, or they've had a mortgage, a house mortgage. And so there's a little bit of a relationship there. And although the business banking group is different, they still see your history, the entrepreneur's history with that bank. And so, even if you can just get a little bit of money in the beginning, obviously you want to invest as much as of your own as you can, but just to get that relationship started and to get that credit history started is very important.
Fantastic. So one of the questions that I often hear from entrepreneurs is, my loan application has been denied. What do I do? But I'm actually curious what your advice is in terms of next steps if in the circumstance in which someone's loan application is approved. If someone gets the loan, then what is your advice? What are the next steps? Because we don't often talk about that. It's sort of, let's get to the goal line, but then once you get your loan, what are your next steps? How do you manage that?
Alex, I'll let you answer that, since you're on the line and you're working every day with people, with entrepreneurs.
Absolutely, definitely. So what I'll say is that this is pretty basic to say, but all I'll say is, please make sure you use your money towards the project that you told your banker you're going to use. Because, and I know that sounds so simple, but I can tell you how many times someone's like, okay, Alex, so I got here's $100,000 for this new hire that's going to help me get to China, or help me now, this new marketer that's going to help me grow. And then I call them 6 months down the road to follow up after the financing saying, hey, how's that going? And then I get, oh, actually, we've been delayed on that. I had some things to pay. So I've actually just been paying off some bills right now. And I'll start with that in next year. And you see then when you have that relationship going over the years, you'll see it's like, well, now they're behind on this project. And you'll see, I've had people come back twice for the same financing they've already been approved for, because they didn't use the cash flow that we approved towards that purpose. So what I would say is being very diligent with using those resources. And again, not to generalize or stereotype, but thankfully women entrepreneurs and studies are a little bit more diligent in terms of using the cash flow finances. But that's really what's important, is making sure that, you're not, buying first class tickets to Tahiti for, a conference the second you get approved. Is that you're saying, okay, I'm going to very much use this smartly, this, $100,000, $150,000, think of it as, don't ever think of it as free money, or unless it's an investment, because think of it as, this money is going to have to be repaid. So let me make sure that every month I am managing what that use is going to be for, if that kind of helps answer the question.
And Nancy, we're going next week, I guess, for session 3, we're going to talk a little bit about, or we are going to talk about, cash flow and the cash flow statement and predicting your cash flow and implementing that loan. So I guess it encourages everyone to come back for next week's presentation.
That's right. Okay, great questions. Someone has asked, with regards to the 5 C's, I find a lot of loans and advertising from banks target young entrepreneurs. How are entrepreneurs over 40 viewed?
Well, it's an interesting question, being well over 4, actually into my 50s now. I would say that it is very important. Young entrepreneurs, because that's typically when, and Futurepreneur, we have a partnership with Futurepreneur, or I guess our young entrepreneur program would be with Futurepreneur, which is 39 and under. I don't know if that's considered young, but I would say that banks are a business, and they are targeting, or they're maybe socializing young entrepreneurs because of the longevity. But I know that many, and we're seeing a very growing trend of, we'll call it mature entrepreneurs, as a second career after they retire, are starting businesses. And albeit, maybe generally banks aren't advertising directly to them. I mean, I know that we, and every bank is as open. At the end of the day, it comes down to looking at the business, looking at the risk. In an older entrepreneur, the bank may be looking at more so its succession plan when they're doing their due diligence. What is the succession planning, depending on the age? I like to say in 50s, I'm still young enough, but depending on the age. But it's I think it's still very important. I don't think they look at it any differently. They're trying to make money just like any other business.
And if I had to add on to that as well too, if anything, as a banker, probably stereotypically or generalization talking, we very much love entrepreneurs in their 40s and 50s and 30s and 60s, especially when it comes to the CCs, because usually they have a very much established credit history. They have experience in their field, or at least they have a diverse risk set of experience to talk about. So trust me, like, there is a lot of beautiful can of worms to talk about when you're working with entrepreneurs in their 40s too. So just because there might not be a flashy commercial, definitely call me any day, and I'll be happy to speak with you. That's for sure. And most bankers, I think, will share that sentiment too.
Good point.
Amazing. So we have a couple of remaining questions, and I think that the questions that remain are probably a little specific. So, and we're kind of coming to time. So I would advise anyone who hasn't had their question answered, I would advise you to reach out to the BDC and connect with someone at the BDC, someone like Alex, an account representative, in order to get your question answered. They are there to do just that. And what we are going to do right now is, I just want to go back to what Laura was talking about, and that is our next session is next Monday, same time, 12 noon to 1:30 Eastern. And we're going to have Laura returning to present on financial statements and lending. So I would encourage everybody, if you haven't already, to sign up, register for this session. And everyone who attended today, I will be sending out the slides and a really great set of BDC resources. So thank you, Laura. Thank you, Alex. Oh, I did want to mention there was a comment posted, much like the comment posted for Laura, saying that, Alex, you rock as a presenter as well, and very, very favorable reviews. So
thank you. That's awesome.
So thank you both so much. And thank you, Shannon, for being with us today on behalf of WEKH.
Thank you.
And thank you to all of the attendees that shared their time with us today. I hope that you learned something, you feel a little bit more comfortable talking about these topics with your clients, with the entrepreneurs that you support. And I hope that we will see you again next Monday. Thank you.
Thank you.
Have a great day.
Bye, everyone.
Bye.
Bye.